All attendees are in listen-only mode.
Hello and welcome to our webinar on the findings of our annual survey of buyers of consulting firms on their M&A appetite and what makes them tick when evaluating acquisition targets. I'm Paula Allerton, Marketing Director at Equitech based in our London office, and our presenter for today is Shant Yeremian, our Buyer Relationship Director from our New York office. Shant will be presenting for about 45 minutes and then I'll be putting your questions to him. Please post your questions using the control panel on the right-hand side of your screen. The question box appears towards the bottom. Over to you, Shant.
Thank you, Paula, and hello everyone, and thank you for joining us in our webinar. Just a quick introduction to myself before we begin. So I lead Equitech's Global Buyer Relationships and Market Research Groups from our New York office. Now what this means is I focus on our understanding of demand for acquisitions of consulting firms, and I build relationships with buyers of consulting firms to help them better enable our transactions. My background is with many of the Big Four, both in transaction advisory and management consulting roles. That's across Anderson, Deloitte, PwC, and KPMG. And directly prior to joining Equitech, I led KPMG's M&A consulting capability in the UK. We have about 50 minutes of content, 45, 50 minutes of content, and we'll take questions at the end. And today I'll be outlining the key findings from our survey of buyers of consulting firms, which is something we publish every year. So I hope today's webinar will provide you with some additional perspectives, some commentary, and some context on the information in our report. So just what you see here is some of the key topics that we're going to cover today. And that includes acquisition activity and near-term demand for consulting acquisitions, buyer preferences in consulting acquisitions, and the evaluation criteria that buyers use. We'll talk about deal structures and those within the consulting sector and consulting transactions involving upfront cash versus the balance of longer-term earnouts, and the importance of intellectual property in consulting deals. And finally, we'll close off with some discussion around post-acquisition integration priorities for buyers and what we're hearing from buyers. Now, all of this is intended to provide a first-hand view from buyers of consulting firms and provide some intelligence for those considering a transaction at this time. Now, for context, I'd like to introduce a little bit about Equitech. I will be brief, but I want to say a little bit about who we are and how we think about the market, which influences our discussion today. So we at Equitech, we're an M&A advisory firm that focuses entirely on the consulting sector and professional services. So 100% of the work we do for clients are those in the consulting and professional services space. We were founded in 2004, and we have a global presence across Europe out of our London office, across the US and North America from our New York City office, where I'm sitting, and in Asia Pacific out of our Singapore office. Now, we believe that we're different than other investment banks and corporate finance houses for two main reasons. One is that consulting's in our DNA, so we approach M&A advisory from a consulting perspective and with a deep understanding of what drives value in consulting firms. And the second major point of differentiation is our ability to assist in the strategic equity improvement of our clients through our knowledge of the sector and our proprietary tools within here. What you'll see on the screen is an example of our framework for equity growth in consulting firms. And behind this framework are a detailed list of 80 questions that we run through clients. And this is a proprietary model designed to provide consulting firm owners and shareholders with effectively a scorecard of equity value for their firm. Here's a quick view of the most recent deals we've done, and on the right-hand side, you'll also see some of the deals we currently have in the market, just to give you a flavor of the type of consulting firms we bring to market and the type of buyers we sell to across the consulting sector, corporates, and private equity. So that's enough about us. What I'd like to talk to you today is, as I said, an overview and commentary of our recently published buyers research report, which you can find on our website. This is the latest iteration of this annual report, in which we survey buyers of consulting firms, really to understand how the market is thinking about consulting acquisitions. This is also useful for buyers wishing to benchmark behaviors in the consulting acquisition market against their own. Now, while the full report covers much more than we have time for today, I do want to provide you with an overview and the material points which I'll present to you. Along the way, I'll also be providing some interpretation and our view of what the market is really telling us. So firstly, why do we do this? Well, M&A within consulting is very active and, as we found, growing as a sector for investment. There's been a lot of general investment advice for sellers, but there's still very little advice available in the market on why or how buyers of consulting firms behave, why they buy, and what they're looking for. So we felt it was important to have a primary and aggregate view from buyers to support and confirm what we're seeing in the market. And so we commissioned effectively an independent and quantitative research on consulting firm buyers to validate the picture we're continuously building in our day-to-day work. This is the second year of this publication, which allows us to compare how buyer sentiment has really changed in the last 12 months. So as we did last year, we commissioned the survey across a diverse community of consulting firm buyers. Combining results from last year and this year also allowed us to compare how buyers' view has changed over the last 12 months. Now, this is particularly relevant given the major trends over the last year, including things like the significant drop in commodity prices, the ongoing slowdown of China, and the increasingly unsettled Europe and ongoing challenges in the Middle East. Now, I'm happy to say, despite all of this, we're very pleased to present some very positive findings of our research, as this represents the realities of consulting firm buyers and their own sentiment going forward. This is just a quick look at some of the statistics of those we surveyed. So geographically, buyers of consulting firms tend to be either global in nature or concentrated within North America and Europe. So the geographical spread of buyers we surveyed reflects that, although there's some representation, obviously, from Asia and South American buyers as well. We also included views from a cross-section of industries, as you'll see on the right. So we made sure to go out to not just sort of managed consulting firms, but also some of the other buyers of consulting firms, including engineering, media, outsourcing, IT firms, and the like. Furthermore, our survey ensured views were provided from the senior decision makers within the surveyed buyers, all of whom had responsibilities for making acquisition decisions. We also ensured that our survey reflected views from both global and regional firms. So overall, all this means is that our survey reflects what we feel like is a direct view from the market and really representative of the market as a whole. So with that, let's dive in and take a look at what we've learned from buyers about their acquisition activity and specifically about future buying trends. So we're often asked about what is the right time to go to the market with the sale of one's consulting firm. And as you'd expect, the answer is always, it depends. It depends on when the seller is ready. It depends on when their people are ready. It depends on when the buyers are ready. And of course, it depends on market conditions and when they're favorable. But the best situation in the market for a firm looking to sell is ultimately when buyers are hungry for acquisitions. One of the main findings from our research is that deal appetite is currently very strong and on the increase within the consulting sector. Our survey shows that buyers expect to increase the number of deals they do by about 15% over the next 2 to 3 years. Now, this is important because it represents about a 2.5 times greater acquisition growth expectation than when we conducted the survey last year. And this is particularly encouraging given the political and economic uncertainty we've seen during the past year, which I mentioned before. Just a quick definition, we define regular buyers as those that acquire approximately one firm per year on average. And prolific buyers, when I speak about prolific buyers, those are firms that acquire 2 or more firms per year. So on average, each buyer we surveyed expects to acquire about 3.8 firms within the next 2 to 3 years. It's clear that prolific buyers, or the serial buyers, have much more aggressive acquisition expectations going forward. And what we heard is that they're expecting an average of 5.3, each one is expecting an average of 5.3 deals expected in the next 2 to 3 years, while the regular buyers were expecting closer to just over one deal per year in the same period. However, any way you look at it, buyers expect to do over 2 times more deals going forward than they did last year. And this is a very positive result. And it's also clear that acquisitions continue to play an important role to enable the growth plans of most firms. Looking at the chart here, we see that over 80% of buyers considered acquisitions to be an integral source of growth, with 36% stating that growth will be mostly acquisitive, and 45% stating an equal balance between acquisitive and organic growth going forward. Also this year, 24% more buyers than last year said their source of growth will be mostly acquisitive. So it's clear that acquisition demand is on the rise and growing amongst consulting firm buyers. Now, furthermore, about 40% of buyers said that they're seeing more acquisition opportunities in the market compared to last year. And this, I think, is a very important point. This highlights a very interesting market dynamic where both the supply and the demand of consulting firms and for consulting firms are increasing or have increased over the last 12 months. There are both more sellers in the market and also more acquisition appetite amongst buyers compared to this time last year. So how much money do buyers have for acquisitions? In line with the increase of acquisition appetite, one would expect that there's also more money this year reserved for deals compared to last year. The buyers we surveyed had a total of 7.7 billion in their war chest set aside for acquisitions, with the average buyer budget being around 72 million over the next year, and the mean range ranging from about 37 million for regular buyers and 103 million for prolific buyers. Now, these are very big budgets compared to what we see last year, and overall this represents again about 11% increase in the average acquisition budget. You can see this broad range of budgets on the chart here that we're showing. So although overall budgets are on the rise, you'll see on the big spike to the right, the buyers are also much more opportunistic in their acquisitions. You'll see here that about a quarter of the buyers said that their budgets will depend on the opportunity itself, implying that a large proportion of budgets are flexible for the right acquisition opportunities. So what does this all mean? Well, it's clear that there's market evidence that transactions in the consulting sector are on the rise. And we've recently seen a number of very high-profile deals in the consulting sector that confirm this demand at the larger end of the market, some of which I've mentioned here. It's also clear that consulting firm targets are increasingly being acquired by other services firms, so what we tend to call as corporate buyers, and also increasingly by private equity buyers, in addition to buyers in the consulting space. Looking forward, our survey suggests that this acquisition appetite will continue, as the sentiment amongst buyers regarding acquisition growth is extremely positive, with a significant amount of capital set aside to enable those transactions. However, we do understand that buyers are also seeing more acquisition opportunities in the market, meaning that there are more firms for sale this year compared to last year. What that means for sellers is that although demand for consulting firm acquisitions is still high, there's also much more competition for the attention of these buyers in the market. So interestingly, this points to a good market for both sellers and buyers overall. But it's very important to ensure that in a sale process, you stand out from the crowd in order to achieve a real premium price given today's market conditions. So with that context, what we also wanted to know is, the size preference for buyers, and let's explore that in a little bit of detail. And this is really about the ideal size of consulting firms that the market is asking for, and that we asked buyers themselves. So size does matter to buyers in any sector of M&A. If the target is too small, it may not be worth the effort of the acquisition. If the target is too big, the integration may be overly complex and oftentimes can be very difficult to absorb into the buyer's organization. Either one has an impact on the value of the acquisition. However, buyers in general tend to prefer big deals that make a big impact. Now, the reality is they don't always get what they want. So in line with the growth in acquisition appetite this year, buyers are also looking to acquire larger firms over the next 2 to 3 years. We've shown here a comparison of the minimum, maximum, and optimum size that buyers said they would look to acquire. And the averages here clearly show an increase across the board, with approximately 20% increase in the size preference at the lower end and 15% size increase in size preference at the upper end compared to the results last year. So as we would expect, compared to the overall optimum size preference of 31 million, regular buyers on average are looking for slightly smaller firms with an optimum size of about 24 million, that's in revenue. And prolific buyers, as we said, are looking for slightly larger firms with an optimum size of about 36 million. This is somewhat intuitive, as prolific buyers tend to be larger than regular buyers, and so therefore would want larger targets. But again, it's clear that both ends of the spectrum have increased in terms of size preference. So what we thought we'd do this year is also cut this data by broad industry groupings of the buyers that were surveyed. And this is just a view of, again, the maximum, optimum, and minimum size preferences for each of those industry groupings of buyers. So what we see here is that the IT consulting and media advisory groups had the lowest size target for acquisitions. The engineering and environmental consulting groups had the widest range of size targets, and management consulting, including finance and accounting groups, had the largest optimum and minimum size preference. So that's what the data is showing. In our experience, IT and media consulting firms can be subject to higher growth rates than those in other sector groupings. And so they tend to also possess more intellectual property by nature of the work that they do. So buyers of IT and media consulting firms with high growth and a good level of leverageable IP may be better placed to show the potential for future leverage in a buyer. So buyers in this grouping, we feel, may see size as less of an issue, and that's certainly what we see on a day-to-day basis here. Listening to buyers of IT consulting and media firms, we see this across the board with buyers being more flexible on the lower end of the size range for acquisition targets with experience in areas like customer, predictive, or market analytics. So, for instance, those using Hadoop on the IT side. Cyber and cloud technologies like Salesforce, Workday, and others. But we know it's difficult for buyers to find firms of scale with these capabilities. So it's clear that buyers in the market are overall are looking for much larger firms compared to this time last year. On average, across all buyers, the minimum acquisition level has increased more than the maximum. And this implies that buyers are more sensitive at the smaller end in terms of their acquisition preference. However, there's 2 points worth making here that I think are important. One is that, when we look more closely at the data, this reveals that there are areas of deep expertise, advisory in certain hot topics, or firms with real quality intellectual property, which we'll speak about in a bit. These are abundant at the lower middle market level and still in very high demand. So that's the point to say that even though you're small, you may have very unique offerings that a buyer is looking for. The second point is that the majority of deals in the consulting market are done at the smaller end of the spectrum. And we know this because we research this and publish this data in our annual M&A report every year. We know that from our research that about 70% of all consulting deals across the world are valued at under $40 million in revenue. This implies that many large buyers continue to acquire smaller firms of good quality or capability, and that there is very strong middle market demand for buyers that are continuously seeking out smaller firms. The reality is that there's a buyer community relevant to firms of any size, and the key really is to understand and identify the market that's relevant to your size and in need of your particular area of expertise. So next, we wanted to know what buyers typically look for when initially evaluating acquisition opportunities. This is very much like reviewing a CV of a recruitment candidate. Buyers are looking for specific criteria that suits their current need and an ability to quickly identify that need and how it fits into their own firm. If you think about summarizing the value of your firm onto one page, it will likely be a combination of financial metrics to ensure that you reflect the growth and profitability of your firm, as well as strategic metrics to ensure your capabilities, expertise, knowledge, people, clients, all of that reflects the long-term value of your firm. So I spend a lot of time speaking to a number of buyers across the world, and although we have much anecdotal evidence of what will resonate with different buyers in the market, we wanted to really validate the common attributes of consulting firms that buyers look for, and that's what this section is really about. So we looked at the different types of quantitative and qualitative metrics that buyers of consulting firms prefer. And one of the key findings was that very few firms look at a balance of both, and that's really interesting. Buyers in general were very polarized. You'll notice on the chart here that across all buyers on the left, few use the balance of both quantitative and qualitative metrics, and most were biased towards one side or the other. We see here also that less experienced buyers in the middle tend to be largely focused on quantitative metrics like revenue and profits. But the more experienced buyers were also much more polarized towards largely quantitative or largely qualitative metrics, suggesting that they really know what they're looking for and what's going to be accretive as an acquisition to their firm. And looking across the different industry groups, we see that IT and media consulting firms and management consulting firms have the most balance in terms of what they look for between quantitative and qualitative metrics. So in terms of what buyers in the market value most highly on the financial metrics side, it was really no surprise to learn that overall profits and growth were the most highly ranked. And more specific metrics around things like revenue per partner or revenue per consultant, although they were still considered, they were not as highly prioritized. Gross margins was clearly here the most important metric around the market for evaluating consulting firms as an acquisition. And the reason for this is that many of you will know gross margins reflect the extent to which buyers can leverage the experience of an acquisition to command a higher price for their offerings in the market. If the added value of the target allows you to sell their time for a significant multiple of what they cost, this makes for a good investment, and this is why gross margin is very closely looked at. Although there are obvious reasons that post-acquisitions, the operating costs of the seller are really absorbed into the buyer, which is why, again, gross margins is often the key metric that buyers look at. Now, qualitatively, we also wanted to know the ranking in terms of importance of what buyers look for and how they evaluate their acquisition opportunities. So looking at the qualitative metrics, the market clearly valued clients and IP most highly in their acquisition targets. The size of a client effectively reflects the quantity and market attractiveness of a seller's offerings, and the most immediate value to buyers for cross-selling or on-selling their services. However, intellectual property in consulting firms is something that we are constantly asked about, and I'll delve into this more a little bit later in one of the following sections. But I can say that the demand for IP in consulting firms has significantly increased over the past few years. The market is really attracted to consulting firms who can capture, codify, or otherwise crystallize their expertise for future use, and effectively disaggregate it from the people in their firm. The most highly sought after attribute of IP is the ability for a buyer to leverage it across their own firm. But it's clear here that the client base, qualitatively is very important, as is the potential leverageability of its IP. So, although the market for consulting acquisitions has different ways of evaluating acquisition targets, there are some common attributes that apply to all knowledge-based businesses. Last year, our survey highlighted that financial stability, the depth of expertise, and intellectual property were three factors that the market found most attractive about consulting firms. So this year, we've refined this view around the prioritization of gross margins and growth on the quantitative side, and the quality of clients and intellectual property on the qualitative side as key considerations when a buyer looks at your firm to evaluate it as an acquisition target. So again, what does this mean for sellers? The profile of your firm that a buyer sees should really highlight the key both quantitative and qualitative aspects of your firm that make it a success and a good investment. Quantitatively, gross margins and overall growth will be looked at in detail, as these two metrics respectively reflect the ability of your offerings to command higher value in the market, and also the ability that you have to scale your firm now and potentially in the future. Qualitatively, the types of clients you serve is a real reflection of the success of your firm and the potential future value you bring to a buyer. In addition, the IP within your firm is very important and should enhance or support your consulting offerings. So next, let's look at common deal structures in the market and how these are changing. Firstly, it's fair to say that earnouts tend to be a reality for consulting firm deals across all buyer types. For clarity, when we talk about earnouts, this is the proportion of your overall purchase price from a buyer that is typically earned over a number of years following an acquisition. Some services firms buying into the consulting sector tend to offer more cash up front compared to consulting firm buyers, and that's in our experience. But in general, an element of earnouts are involved in every deal we see in the consulting sector. Since these are largely people-based acquisitions, earnouts effectively mitigate the risk of the people or the real assets that you're buying walking out the door post-deal. So our survey confirmed that earnouts continue to be a big part of consulting acquisitions for most buyers. This has slightly increased from last year, but there was also a greater proportion of earnouts that achieved their targets based on what we've heard from the market. If you think about that, if the success of an acquisition is really measured by a greater number of acquisitions hitting their earnout targets following a deal, then we can really say that consulting acquisitions have been more successful this year than last. The range of upfront pay in consulting deals is broad. but on average, a 45% upfront payment is most likely in the market, with the balance contingent upon achieving earnouts over the following approximately 3-year period. It's also fair to say that buyers tend to offer more upfront cash and less in earnout for really top quality firms in hot areas, simply because there's more demand in the market for them. So in an environment of growing acquisition activity and appetite, what we see reflects an M&A market that is becoming a bit savvier in consulting deals, and where buyers are much more focused on the successive acquisitions in terms of their integration following the deal. This year, the average earnout period slightly decreased, but it remains to be seen whether this is a significant trend in reducing in the reduction of earnout periods. However, as the need for more deals has increased, so would the pressure to quickly integrate those acquisitions and move on to others. So reflecting this, experienced or prolific buyers are more likely to offer an earnout period of 2 years or less, whereas regular buyers who acquire one firm per year on average are more likely to have a longer earnout period lasting 3 years or more. With regard to the types, with regard to typical, the targets typically used for earnouts, we see that these have remained largely similar to what we heard last year. So buyers often prefer sales-driven metrics of gross margins and revenue that concentrate on top-line growth and that are easier to measure post-acquisition. So on average, the retention of key personnel and a measure of EBITDA were given a lower priority. So why do buyers not like to measure earnout period based on bottom line figures like EBITDA? Well, the EBITDA point is explained by the difficulty to measure the bottom line as the acquisition is integrated. So if the seller is integrated into the buyer post-acquisition, which is what tends to happen in most cases, then it becomes increasingly difficult to attribute the financial success of the firm to its original structure. However, notwithstanding the average results shown here in the market, in our experience, when buyers are more aggressive on the acquisition target, they will often offer an earnout based largely on retention, effectively to sweeten the deal. But that's provided that they have a high confidence in the future performance of the acquisition. So, to summarize, earnouts are still very pervasive in the overall M&A market for consulting firms, and on average, this has not really changed much in the past year. But what we see from these results is the aggregated view from the overall market. In practice, we see different cases. Some of this is self-selecting for intermediaries like us. We source and bring to market very high-quality firms that create competition amongst buyers. And in this process, we're seeing really 3 main trends when it comes to deal structures offered by buyers. The first is that high-quality firms break the trend of the overall market with respect to the averages or typical earnouts that we've heard from buyers, and that's clear to see. The second is that we're seeing more 100% cash upfront deals, provided there's a good management team in place to drive the growth going forward, without any individual dependencies on senior management. And the third is that we're also increasingly seeing deferred payments rather than earnouts that are contingent upon performance. So these are earnouts that are contingent, either non-contingent or simply contingent on the senior management remaining with the firm for a number of years following the acquisition. So why is this? Well, with increasingly acquisition appetite in the market and demand for high-quality firms, there's more competition we're seeing for the right firms. Buyers in competitive situations for firms tend to alter the deal structure rather than the overall price that they offer in order to make their offers more attractive. So they'll more often offer more cash up front and less of an earnout rather than offering a higher overall consideration. So this results effectively in higher upfront payments and shorter earnout periods. But again, these scenarios exist really only for the highest quality firms and those with the lowest risk, which tend to be rare in the market. So our next topic is intellectual property with consulting sector deals and how this is really viewed by buyers in the market. You know, we know that intellectual property is really highly valued in consulting firms. And last year, our survey confirmed IP as a key attribute that attracts buyers. In effect, the development of IP for a consulting firm is really a way to crystallize and externalize the expertise of a firm. And this helps to mitigate the dependency on the individuals and ultimately helps build operating leverage in the firm, whereby a firm can scale without necessarily having to proportionately increase the staff and costs. The market for M&A in consulting seems to recognize that. And as we've seen from this year's survey, about 68% of all buyers found IP extremely or very important as a factor when assessing acquisitions. What we're, again, often asked about by sellers is whether their IP will be attractive to others. But IP is unique to each firm and can take many forms. And as such, its value is not always either easy to define or understand by an external buyer's perspective. So the real challenge for buyers is often about finding consulting firm acquisitions with the right kind of IP to leverage. So this leads us to a discussion around what types of IP are most highly valued in the consulting firm transactions. And this is something we wanted to ask buyers about. Our view from the market is that buyers were most attracted to IP in consulting firms that really generates complementary revenue streams to consulting services, which again is not entirely surprising. So this would include software or subscriptions as opposed to any other types of IP. Now, while this is somewhat unsurprising, most consulting firms in the market do not have separate software-driven revenues. So the attention really turns to all other types of non-directly revenue-generating intellectual property, or effectively those three bars to the right. So beyond software or subscriptions, we found that IP in the form of methodologies or proprietary assessment tools were also highly valued and in demand for buyers. The reason for this type of IP the reason is that this type of IP can be used to effectively enhance the consulting offerings, standardize delivery, and enhance the scalability, or ultimately even just better enable the growth of a firm. Although benchmarking data and industry databases that you see there on the right, it's interesting that they were least highly valued across buyers within these categories. If we view here, again, the different responses across the industry groupings, we can see that buyers in the management, consulting, and accounting groups stood out as being the most interested in this type of IP at the lower end. This really can be explained by the fact that buyers in the management consulting sector are really better placed than those in the other sector groupings to make use of benchmark IP. Our view is that if a consulting firm target has really proven its ability to scale using its own intellectual property before approaching a buyer, then the value of that IP is slightly more obvious and directly proven compared to intellectual property like benchmark data, which cannot really be fully assessed by a buyer and whose value cannot really fully be known until the deal is done. So this is why most sector groupings of those surveyed preferred methodologies and tools as IP when seeking out acquisition targets. So one point we recognize about IP in acquisition targets is that it's unique to each firm. The fact that it's only used and understood internally within a firm is what really can make it a competitive advantage. However, this can also prevent a buyer from fully understanding its value when assessing a target. So often, a firm's IP value is diluted in the eyes of a buyer. So because of this, we wanted to know the challenges most buyers face in assessing the value of IP in their acquisition targets. What you'll see here is the largest proportion of buyers, about 44%, said that the biggest difficulty in understanding is in understanding how the IP contributes to the success of a firm. Now, this means how the IP in a target acquisition firm directly drives or supports revenues, profits, or growth. Many would also suggest that although they understood the value of the IP in the target firm, they found it difficult to understand how they could leverage that IP within the buyer's firm. So it's clear that most buyers prefer IP that directly generates revenue for a consulting firm, and that intellectual property like methodologies, tools, and techniques were still a close second. Buyers also felt that they can leverage a target's IP only if it enhances their consulting offering and standardizes its approach. Separately, we found that IP is more important to experienced buyers. So 73% of prolific buyers who have much more to gain from the intellectual property found it extremely or very important in acquisitions. And finally, management consulting, IT, and media all attributed the highest importance to IP compared to other sectors of buyers. Now, finally, I just wanted to touch on post-acquisition integration, and we wanted to hear this directly from buyers as well. So we focused our last section on this in our survey. We asked buyers about their highest priorities in the first 90 days post-acquisition, and the results were quite encouraging. So you'll see here that really people come first. As people are the main asset in a consulting firm, buyers understand that attrition shortly after or during a transaction is highly corrosive to the value of a people-based firm. So to avoid this, experienced buyers know that communication with their own staff and that of the target, as well as culture, are paramount to facilitate the smooth integration. Next is the integration of clients to enable the cross-selling and on-selling, which is where really the majority of synergies lie that tended to be hypothesized pre-deal. And you'll see here the last three areas of operational and financial and technology integration were then left far behind the original two. While these points are clearly critical to the full integration of an acquisition, they were seen as less risky as opposed to losing people or losing clients. So we also wanted to know the typical length of an acquisition integration program across the market. And we found that on average, integrations last about 19 months from start to finish. This is slightly less for experienced buyers and slightly more for those less experienced, which is, again, a natural conclusion. So with regard to integration, the clear message is that people and client integration are most often prioritized above the more mechanical integration areas of operations, finance, and technology. However, again, 2 points really stick out here from the data. The first is that the end of an integration program is not often well defined. So, many of you will know that integration takes place in major step changes that may take place in phases, but there's often a long list and a long tail of items that require integration well beyond the official end date of an integration program. The second point that sticks out is that integration activities can complicate an earnout performance. So as firms get closer together, if the earnouts are not based on clear, measurable, and again, more top-line or individually based performance metrics, the two can be at odds with one another. In reality, what we find is that this can happen, but tends to be less common with experienced buyers. So just in closing, I think what we've seen is that the overall picture is very positive, and it's a very good picture for both sellers and buyers of consulting firms. There's increased buyer appetite and budgets for consulting firm acquisitions. There's a significant both are a significant increase from last year. We've seen that both quantitative and qualitative metrics are used to evaluate the firms, but the market tends to be polarized in which one they actually use. We've seen that earnouts are common in the industry in terms of deal structures, with approximately, on average, about a half given up front in cash and a half based on an earnout over 2 to 3 years. And that earnout, if based on performance metrics, tends to be based on top-line metrics like gross margin. And post-acquisition, the market tells us that people and clients come before operational, financial, and technology integration. So that concludes the content section of our presentation. And I'd like to move on now to any questions you may have, and some that may have been asked during the course of the content.
Thank you very much, Shant. Thank you for that. And thanks to those of you who have sent in questions. We're going to try now to answer as many of them as possible. So firstly, Shant, somebody's asked, regarding earnouts, is there a big difference between the averages we've heard about in this presentation and what you see in practice on a day-to-day basis?
Yes, I think I mentioned before that there's often a difference between what buyers will expect, or what buyers want to see or expect to offer in a deal, and what they end up offering for specific targets. So I think there is a difference. There's if you go into the market expecting the averages, I think that's a good place to start. In practice, I think it will depend on the type of firm that's sold into the market. Those that have deep expertise in a specific area that's in high demand amongst the buyer community they've gone out to. Those with things like leverageable intellectual property, which we've talked about, and a key client base. Those types of firms tend to be the ones that are most highly valued amongst buyers. And so when there's competition, what we see is that buyers coming in will start out with closer to the average of what we've seen in terms of deal structures. So offer about half upfront and half as an earnout. And as the competitive tension rises during the process, then certain buyers will offer more cash up front, and that may end up being the structure of the ending deal. So oftentimes there is a difference between what we see as averages in the market and what we see on individual deals, but this really depends on the quality of the firm being sold into the market, and also the buyers that are approached.
Thank you, Shant. And then somebody has asked, you've asked buyers about their intentions going forward, but do they often find what they're looking for in terms of size and IP, etc.?
Yeah, I think that's a great question, and one that we're asked very often. What we find is that buyers often want bigger deals than those that are available in the market. The reality of the consulting market is that, like we said, about 70% of all transactions in the consulting market around the world are those that are valued at $40 million US dollars or below. And what that points to is that, many of the firms that are sold into the market are at the smaller end of the spectrum. Buyers tend to prefer bigger deals than that, but the reality is that the supply of firms in the market tends to be concentrated at the lower end, because they're often acquired before they get to about 50 million in revenue. So what buyers want, again, in terms of size, is not often what they get. And there is also a little bit of flexibility, like we talked about before, about when a firm is smaller, but they have particular areas of expertise or leverageable intellectual property, then size becomes much less of an issue, because the buyer can see the future potential as at a much higher rate of growth than if they were to buy a bigger consultancy with less potential future growth.
Thank you, Shant. Is there any sense of typical quantitative benchmarks for valuation, either, for instance, revenues or EBITDA multiples?
So in terms of valuation, all buyers will start out with, I think not all buyers, I shouldn't say all buyers, but most buyers will start out with the typical valuation methods, looking at cash flow, and that's often, a fundamental analysis that most buyers perform. I think the way we do it, it's very difficult for consulting firms to project out, more than 2-3 years in advance, simply because consulting by nature is project-based, and projects, most projects in consulting in general tend to last, no more than about 2 years, unless it's a very long consulting IT implementation project. So the reality is that it's very difficult to predict consulting firms' cash flows more than 2-3 years in advance. So because of that, what we tend to do, and what we find buyers tend to do, is look at a period of 2 to 3 years prior cash flow, so 2 to 3 years of cash flow prior to the current date, and look at 2 to 3 years forward cash flow, and discount that appropriately according to the market sector and where they sit in the market. So in terms of valuation metrics, it's a difficult question to answer, because it really depends on the type of consulting firm. But I think all buyers will start out with some sort of fundamental analysis and valuation analysis, and look at market multiples. Now, I should mention, if the second part of that, the answer would be around market multiples, and we do publish this every year, and you can find this in our consulting M&A report. So there's a global average for consulting firm valuation metrics, which is roughly about 1 times revenue. But again, I should mention that's a global average and incorporates all types of different consultancies. And the range is effectively from about 0.5, 0.6 times revenue to upwards of 2 times revenue. And the range there, it really depends on the type of consultancy you are, the sector of the market you're in, and your ability to generate future cash flow.
Thank you. And one more question. So how important is cultural differences of target firms in determining if a target is appropriate or not? So for instance, if you have a well-paying employer who's considering a high-end firm with top talent that's paid well, so cross-geography, potentially, cultural differences.
Yeah, I think cultural differences are very important in consulting deals. I mean, when you look at transactions in consulting compared to other sectors, you're buying people, and buyers are, that's what they feel like. They're buying a set of people and a set of expertise, and they need to work with these people. So culture is paramount in these types of deals. What we find is that culture is something that's very high on the mind of buyers, but buyers don't often tend to diligence culture in the same way as they would diligence the financials of a firm before they acquire it. I mean, simply because it's very difficult to do that. It's a very ill-defined sort of measure that allows you for an acquisition to be either a success or not so much of one. So what buyers tend to do is assess the culture of a firm in the meetings that they have leading up to their offer. So they'll meet with the senior management. They'll ask specific questions about how their people are treated, how the growth potential of their people and the growth potential of their firm. And they might even meet some of the senior management that's sort of lower down from those that they're meeting, in order to get really a sense of the culture of a firm. But in answer to the question, I think culture is very important in consulting deals. It tends to be very difficult to measure.
If you don't mind, Shant, I'm going to just pose one more question for you. What is driving the growth in acquisition demand that you spoke about at the beginning of this presentation?
Yeah, it's a great question. So There's a number of different factors that we think are really driving growth. One is that for a long time there's been a lot of pent-up demand that hasn't really been released yet in the market following the 2008 credit crunch. So we've seen transactions steadily increase year on year since then, since about 2008, 2009. But not in any sort of major burst. I think that there's, so what that means is there's a bit of pent-up demand and pent-up funding that really needs to be released. Maybe as part of that, consulting firms have, as the economy has increased over the last number of years, they've built up a big cash reserve, particularly the publicly listed consulting firms, that they need to do something with. So they could either return that cash to their shareholders, or they can make investments. And most firms tend to prefer to make investments rather than give cash back to their shareholders, for the simple reasons that reinvesting in the firm is potentially builds future growth. So that's certainly a factor. The other major factor is that we've seen since 2008-9 a real big increase in and real change in the technology landscape, both in consumer technology and business technology, and this has had a cascading effect on all areas of consulting, to the point where we're seeing a lot more acquisitions of data analytics firms by strategy firms, or things like cloud consulting and cloud technologies have a big impact on areas of Salesforce or on supply chain. So I think the change in technology has acted as a real driver for both demand for consulting services and also therefore in demand for consulting firms across the board.
Thank you, Shant. That's all we have time for now. If you posed a question which we haven't had time to answer, then we will get back to you after the event. So please don't worry about that. If you'd like to discuss the webinar or any aspect of your plans to sell, please don't hesitate to contact either Shant or myself on paulaallerton@equitech.com. If you aren't already a member, then please do join our Equitech Edge Club. It's a free source of information for consulting firm owners looking to realise equity value in their business. You'll find expert guidance, unique research, guest articles, and lots more, including a monthly newsletter. Thank you, Shant, for a very insightful presentation, and thank you to everyone for attending. A recording of this webinar will be available within 24 hours, and we'll be sending you a link. Finally, if you have any questions or comments, please feel free to contact us. We'd love to hear from you. Thank you very much.